4 top dividend growth stocks just reported earnings, and all of them are selling off. Today, I'm going to give an updated stock analysis on each of these companies to see if the sell-off is an opportunity for investors. The 4 stocks include household names like Nike and FedEx, top tech consulting firms like Accenture, and a high-growth financial software company, FactSet. What unites this group is they all have a history of paying growing dividends. They have starting yields of 1 to 2.5% and historically have had a strong total return. So let's roll the intro and start the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using the best stock research tool for dividend growth investors that is available at dividenddata.com. And now is a great time to join because we have a special March Madness sale, which is only going to be available for a little more time. You can lock in 50% off your annual membership. The link will be in the description and pinned comment of the video. If the tool helps you find just one better stock, then it way more than pays for itself. For stock number 1, we have Accenture, ticker symbol ACN. This company just sold off 7.2% after reporting earnings. So I'm going to give a big picture look at their stock and then break down exactly what happened in this earnings report. So as you can see, this is a company with consistent earnings growth over the long term, and that has led to pretty good stock price performance. This company has also been a dividend growth stock for decades. They originally paid annual dividends, then moving to semi-annual, and they have now switched to quarterly payments. For example, their most recent dividend increase was 14.7%. The 5-year compound annual growth rate of Accenture's dividend is 13%. And considering you have a starting dividend yield right now of 2%, that seems pretty attractive for the dividend growth investor. This dividend is also quite sustainable with a 37% free cash flow payout ratio and 44% net income payout ratio. On top of dividends, the company buys back a modest amount of stock every single year. They have a pretty strong balance sheet with $8.5 billion of cash on hand. That gives them net debt of negative $2.65 billion. So overall, this company has a strong balance sheet. Revenue per share has grown at an 8% 5-year compound annual growth rate. Free cash flow per share has grown at a 7.7% 5-year compound annual growth rate. And as of right now, analysts are still projecting pretty good earnings per share growth in the coming years. And based on analyst price targets, the stock appears to be 27% undervalued. And if we look at the latest earnings for Accenture, you can see that they beat slightly on both revenue and earnings per share expectations. But really, we need to dive a little bit more into it. So I used my AI analyst to help summarize the report and get a look at their outlook. So both revenue and earnings per share on a year-over-year basis were pretty strong for the quarter. Revenue grew 9% year-over-year. And earnings per share came in at $3.64, which was 15.9% growth year over year. And as I mentioned earlier, this is a technology consulting company, so they help large corporations modernize their business. So a lot of their workforce historically has been software developers and engineers and product managers, etc. But recently they've been investing a lot, of course, in data and AI. And they've recently invested over $250 million to have 6 strategic acquisitions in that field. And now their overall data and AI workforce is 72,000 employees. And AI is a big new product category for Accenture. Again, they're helping bring AI to all of their customers. And they just reported $1.4 billion in new bookings for their generative AI business. And just in this quarter, they did $600 million of revenue, which just shows how fast this business is growing because in the entirety of last year, they had $900 million of generative AI revenue. And despite the stock going down, their future outlook was actually pretty strong. For the fiscal year 2025, they're anticipating revenue growth of 5 to 7% in local currency, with 3% coming from inorganic contributions, so I assume that would mean their acquisitions. Now, that growth is actually slower than it was last year, but analysts were pretty bearish on it going into the quarter. And for earnings per share, they're expecting $12.55 to $12.79, which would be 5 to 7% growth year over year. But a big negative going on with Accenture, especially in the mind of investors, is that they are a consulting company and one of their clients is the federal government. And as you've likely been following, you have the whole Department of Government Efficiency making big cuts, and a lot of those cuts are around consulting. However, I do think Accenture is far better positioned compared to many other consulting companies. And the reason is that the federal government business is only 8% of their global revenue. They primarily work with private corporations, so this is a small portion of their business. And then the other thing is that this is a technology consulting company, which should probably be one of the last things that the government ends up cutting. And the Accenture CEO was just on CNBC talking about how they hope that they can pitch as being a useful thing in this government efficiency movement. And I have been following this recently, and I found this company, Booz Allen Hamilton, ticker symbol BAH. This company may be in for some trouble when it comes to that. They get approximately 98% of their $11 billion annual revenue coming from the US government. I would be way more worried about a company like this compared to Accenture. And to be honest, I'm surprised that Booz Allen stock isn't down even more. Of course, these cuts won't be reflected in these earnings or the coming quarters. If we look at the earnings per share of Accenture over time, you can see that it is a pretty strong growth business. And with this recent sell-off, we're now getting to one of the highest dividend yields for Accenture stock over the past 5 years. A 2% yield is not bad if they can keep up this 10 to 15% dividend growth. Even with this recent sell-off, the 5-year total return is 125% for Accenture stock. And since 2001, the company has a total return of 2,739%. For stock number 2, we have FactSet Research Systems, ticker symbol FDS. This is a financial software company that's starting to get on my radar. They're not even that big. They have a $16 billion market cap. And if you look at this earnings per share chart, this is as reliable as it kind of gets. And that has powered great returns for investors in the stock market. They just reported earnings today and the stock went down 1.7%. FDS stock has a current dividend yield of 0.97%, and they pay a quarterly dividend that's been growing on an annual basis for decades. The 10-year compound annual growth rate of the dividend is 10.31%. Although this has been slowing down lately, the most recent increase was 6.12%. However, it is a very sustainable dividend with a 24% free cash flow payout ratio and 28% net income payout ratio. And it's always in this very sustainable range. The company also does buy back a small amount of stock. And if we look historically at their key financials, revenue growth has been very good. Revenue per share has grown at a 10.15% 10-year compound annual growth rate. This is a pretty high margin business with 54% gross margins and 24% net margins. Free cash flow per share has grown at a 10.56% 10-year CAGR. They have about $1 billion of net debt, but that's not that bad. They have pretty good cash flow. The company just reported their earnings and they beat EPS by 2.39% and they met estimates for revenue. And if we dive a little bit more into their earnings report, you can see that revenues were up 4.5% year over year. For this company, they also report their annual subscription value, and that organically was up 4.1% year over year. Earnings per share was up 3% year over year. And they gave pretty good guidance. They're expecting continued growth in annual subscription value. I'm not an expert on this company, so maybe I need to do a full stock review on it. But I did just add the stock to my personal watch list so I can keep it on my radar. On a historical basis, this is always a pretty low yield company, around 0.5% to 2% starting dividend yield. And if we look more recently at the past 5 years, this current 1% starting dividend yield is in the upper range. The only time it was notably higher was during that 2020 crash. So for a company like this, a 1% yield may be a decent entry point. The 5-year total return is 120%. The stock has been pretty flat in the water for the past 3 years. The 3-year total return is 1.6%. But on a long-term horizon, this has been a great compounder in the stock market with a 12,200% total return going all the way back to 1996 when they went public. So if you're a dividend growth focused guy, this is an interesting one to have on your list. For stock number 3, I have Nike, ticker symbol NKE. I'm actually wearing Nike in honor of this video. The stock just reported earnings after hours, and it initially got good praise because, as I will soon explain, they beat their estimates, but investors did not like what they saw in the earnings call because then the stock fell off significantly, down 5.2% from its closing price. And that will make the company down more than 60% from its all-time high. In fact, that $68 amount will be below its 52-week low. Nike stock has had quite the drawdown over the past 5 years. In fact, this is one of the worst drawdowns in the entire history of Nike. During the great financial crisis, they were only down 40% from its peak. They briefly hit this in the dot-com bubble, and they also hit this in the 1990s, which was really before the peak of Nike. So as we look at Nike stock, this could be a long-term buying opportunity for a high-quality company with a strong brand. But to be fair, this buying window may be open for a good period of time because their fiscal 2025 is going to be pretty bad. It was already expected to be bad. And then you add on top of that tariffs, which will hurt a company like Nike, which manufactures most of its products overseas. So 2025 may continue to be weak for Nike stock. But if you take a long-term perspective, there may be some pretty good buying opportunities this year. Nike has consistently grown earnings over the long term. and it is a sneaky dividend growth stock. The current dividend yield is 2.23%, and the dividend payment has grown at an 11% 10-year compound annual growth rate. And this has remained pretty high lately. The most recent dividend increase was 8%, even with their recent poor financials. The dividend is sustainable too. They have a 32% free cash flow payout ratio and a 38% net income payout ratio, and it's always in a sustainable range. They also buy back stock consistently. Revenue per share has grown on a long-term basis with an 8% 10-year CAGR. Free cash flow per share has grown at a 7.5% 5-year CAGR and a 13% 10-year CAGR. They have $2.3 billion of net debt, but this company generates a lot of cash flow, so I don't really view that as a problem. So overall, the financial health of Nike as a business is strong, and the valuation has come down a lot. But let's dive into why 2025 is such a bad year for the company. So here were the results of Q3 earnings versus the estimates among Wall Street analysts. They beat on revenue expectations by 2%. And here's the big one. They beat on EPS estimates by 86%, 54 cents per share versus 29 cents per share. And that's why the stock boomed initially after earnings. But the expectations were just pretty terrible. Even beating on these metrics, they still decreased significantly year over year. Revenue came in at $11.3 billion, which was a 9% decrease year over year. Gross margin decreased by 330 basis points. And a lot of this is because they got a new CEO, a new strategy, they're transitioning their product portfolio, so they're discounting on a lot of their old inventory. And this is expected to continue throughout 2025. As we can see, they gave outlook, which I think is where the stock came down. They're expecting to have the most significant impact in Q4 2025. Revenue is expected to be down in the mid-teens year over year, and gross margins down 400 to 500 basis points. On that earnings call, they also mentioned the impact of tariffs. They included an estimated impact of new tariffs, which would be the reciprocal tariffs that come into effect, I think, on April 2nd. Actually, I don't even know if they've included that yet. This is just on the China and Mexico tariffs. Nike said that they are expecting these to negatively impact their gross margins by 400 to 500 basis points, which only adds to the near-term financial pressure. And if we look at how Nike gets their products manufactured, it's all international, mostly in Vietnam, China, and Indonesia. So it'll be interesting to see how this ends up developing. Overall, I think it's safe to assume that Nike will continue to face short-term pressures, and the sell-off for Nike stock could continue. But as I mentioned, that may end up being a buying opportunity if you have a long-term focus. For example, if you're a dividend investor, this is one of the highest dividend yields you could buy Nike stock at ever. It was only higher in terms of dividend yield in the Great Financial Crisis. It is by far the highest dividend yield of the past 5 years. And with this coming sell-off, that dividend yield may be hitting 2.5%. Now, Nike has been a terrible investment for the past 5 years. The total return's 21%, and it's negative 43% over the past 3 years. But keep in mind, if you're looking at Nike stock right now, you're not buying it 3 years ago. You'd be considering buying it in 2025. And on a long-term basis, Nike stock has been a great compounder in the stock market. Since 1990, this stock has a total return of 12,700%. That's even after falling 60%. The total return at its peak got nearly 30,000%. So I think if you're a long-term dividend investor, you probably should have this stock on your watch list. And finally, for stock number 4, we have the FedEx Corporation, ticker symbol FDX. This has been a long-term dividend growth stock. The current dividend yield is 2.24%. However, they just reported earnings and sold off 5.6% after hours. So that's going to shoot this 2.24% dividend yield up to around 2.37. And as you can see, this has had some huge dividend increases over time. The 10-year compound annual growth rate of the dividend is 21.31%. The most recent increase was 9.5%, and the one prior was 9.5%. But the one before that was 53%. And the payout ratio is still sustainable for the company at a 40% free cash flow payout ratio and 29% net income payout ratio. They've also been buying back stocks since 2013. Revenue's grown at a 9% 10-year compound annual growth rate. Free cash flow per share has grown at an 18% 10-year CAGR. However, it does seem like growth has largely plateaued at the company in recent years. And likewise, the stock price has plateaued in that time. I haven't done a deep analysis on this company, but it seems interesting that analysts are projecting very high earnings growth for FedEx in the coming years. So high that in 2029, they're projecting $34 of earnings per share. So they're expecting the company to more than double, and that would put the P ratio based on today's prices at 7. So if they can hit those kind of numbers, then FedEx stock may be a pretty good value right now. The consensus price target is $311, which implies the stock is 26% undervalued before this recent sell-off. If we look at their earnings, you can see they beat revenue expectations by 1.42% and they missed EPS expectations by 0.66%. And if we take a deeper look at their earnings report and recent financials, you can see that earnings per share decreased 15% year over year. And over the trailing 12 months, EPS came in at $15.91, which is a 6.7% decline year over year. However, they were able to increase their operating income due to their $600 million Drive savings program. And in terms of their outlook for 2025, you can see that they expect revenue to be flat to slightly down year over year. So that could be part of the reason why the stock came down. They also adjusted their earnings per share outlook to be lower with a range of $18 to $18.60. So anytime you're lowering outlook, that usually will mean the stock price comes down. They also have their continued cost saving program. They say it's on track to achieve $2.2 billion in incremental savings for fiscal year 2025. And they're also trying to reduce capital expenditures to $4.9 billion, down from $5.2 billion. And if you follow me for a long time, and if you're a dividend investor in general, you know you want lower CapEx because that will boost your free cash flow and there's more money to then redistribute to shareholders. They just completed $500 million in share repurchases. So if we look at the historic dividend yield for FedEx, you can see right now it's historically high. And really the only times it's been higher was during the 2022 sell-off when the stock got pretty cheap, and then during the 2020 crash as well. So on a historic basis, this could be an interesting entry point for FedEx stock. Since 1992, the company has had a total return of 3,100%. The 5-year total return is 140%. However, it hasn't done that well over the past 3 years. The 3-year total return is 15.8%. So those are 4 top dividend stocks that just reported earnings and are selling off. If you want to use any of the stock research tools I showed throughout the video, they are all available at dividenddata.com. That includes the AI Analyst and the Stock Analysis tool. Now is a great time to become a member of dividenddata.com because we have a special March Madness sale where you can get 50% off your annual membership. And if the tool helps you find just one better stock, then it way more than pays for itself. Again, the link is in the description and pinned comment of the video. With that said, thank you for watching and subscribe to the channel for future stock analysis content. See you then.